Good afternoon, everyone, and welcome to the inaugural webcast for DoubleLine's asset-backed securities ETF with the ticker DABS. We're excited about this vehicle. Historically, asset-backed securities have largely been in the domain of institutional investors, but this is the first vehicle that gives all investors the ability to access this market through a liquid ADS-centric fund. We do think it's an opportune time for investors to consider asset-backed securities. The market's been growing. It offers some great opportunities, and we do believe that it will continue to evolve. And with that, the opportunity set will continue to evolve. As we start, let's spend a minute and define what asset-backed securities, or ABS for short, are. These are fixed income investments where the investor is directly secured by the underlying asset and then the cash flows associated with those assets. Now, activities that you might do on a daily basis would be encapsulated here. Perhaps you might use a credit card to make a purchase, step on a plane to travel, or more commonly these days is use Chat GPT to research a topic. Investors in asset-backed securities are secured by assets that drive our real economy. On this table, we're looking at the types of assets that secure ABS investments, and we divide the market into consumer and commercial assets. The consumer segment is the blue segment on the screen. This is, most people will be familiar with these assets, but ABS gives investors the ability to invest in this key driver of our economy on a secured basis. Alternatively, you also have commercial assets or hard assets. This is going to be the beige shaded area on this table. These provide a service that, oftentimes they remain resilient even in weaker economies. Example I might give here is a power plant that produces electricity. The ABS sector, it covers so many different industries. For today's presentation, I'm going to focus on a few. I'll focus on consumers, transportation, and telecom, as these are the areas we've built the portfolio around given the current opportunity set. So many variables that dictate the direction of the US economy, probably none more important than the consumer. Here we're looking at a time series of US GDP, and this is going to be the black line on the screen. And then the bar chart in the background, it's charting different segments that drive GDP. In 2024, majority of the economists out there and a large portion of investors believe that we'd seen the onset of a recession, but that never materialized. And what I want to do is I want to draw your attention to the 2024 period on this chart, and then specifically focus on the dark blue portion of the bar chart. That's going to be the consumer or consumption. You'll have to remember the economy in 2024 is dealing with, kind of post period of a rapid rise in interest rates. We were coming off a very tough bout of high inflation, but the consumer was much more resilient than most expected. And you can see that with the elevated blue bars on the screen here. And a result of that, growth really held up in 2024. We had a GDP that hovered right around 3%, and we sidestepped a recession. So far, though, in 2025, it is a different picture. And you can see that with consumption being a very just kind of small sliver there of blue on the far right, consumption has slowed down noticeably. And with that, we do see a weaker growth outlook and also lower GDP prints so far this year. The labor market is going to be an important variable here, and it will heavily influence consumer behavior. The black line on this chart is a regression of several labor market indicators. Clearly, it can be seen here that labor has softened from the record strength, really kind of post-COVID. But the black line, it's still above the horizontal axis at zero. And what this tells us is that the labor market remains above its historical mean. Now, we've seen some stronger retail prints recently. So far this year, we've seen stronger retail data. And then most recently, American Express earnings call suggested that the top tier consumers are continuing to spend. So, at this point, there's still some resiliency left to the consumer. And with that in mind, we would characterize the labor market today as slowing, but not quite weak just yet. Naturally, with the kind of slowing labor, there is going to also be wage normalization. Here, what we're looking at is a 12-month moving average of wage growth, and it's broken out by age cohort. For every age cohort, wages are down. from their peak levels, but we are still seeing positive growth. The youngest portion of the workforce, and that's going to be the top line over there. It's age 16 to 24. Lines in green. Uh, we still see wages growing above 5%. Uh, as wages as wage growth declines, an expectation would be that you do see consumers pull back. We certainly saw that in the first quarter of this year, but then also potentially affect their ability to meet their liabilities. And that's going to be what we're most concerned with on the consumer. If they can no longer meet their liabilities, um, that's really kind of when we do see some stress in the overall economy. We do have a slide on that in just a minute here, so I will address that. As labor and wages soften, we do ask ourselves what the financial state of the household is. On this chart, we see the unemployment rate, and that's going to be the blue line. And we're comparing to the beige line, which is a ratio of net worth to disposable income. The beige line, what it tells us is that households, they're sitting on the most wealth they've had in decades. And if you compare this to the period preceding the great financial crisis 2008, wealth levels are much much higher today than we saw back then, and this would suggest that households have a pretty substantial cushion to absorb economic stress should unemployment rate rise or wages continue to decrease. We see this as a risk mitigant within the consumer sector. In the past, the real trouble began when lending standards became very loose, meaning credit extension was relatively easy. What we're seeing in the market now is very disciplined lending practices. On this chart, we're showing bank lending standards, and this is the blue line, where the line is above zero on the horizontal axis. Lending standards are tight or very disciplined. Below zero, then lending standards are more relaxed. So it does bode well for the health of the market that lending practices have tightened, especially as labor and wage data have been softening into this year. Now, one thing I do want to point out is 2022. You do see the blue line dip pretty kind of deep below the zero on the horizontal axis. That indicates that lending was very very loose or easy. And I'll have another slide there that kind of shows you the ramifications of that. But before that, let's just look at how consumers are faring with slowing labor and falling wages. Here we see a time series of delinquencies by different consumer sectors. Auto loans, they're in blue, credit cards in the navy or very dark blue, and then student loans in beige. Student loan data here is going to be comprised of the federally funded student loans, and these are held on government balance sheets. I do want to define this because I use the same data on the next slide to compare another set of data. Now, delinquencies, they're rising across all consumer sectors, and you can see this with autos and credit cards and students. And we're seeing this across all borrower cohorts as well. So the very worst credit quality borrowers, the subprime, all the way to the best quality, the prime cohort, we're all seeing increases in delinquencies. So that does indicate some type of stress. Now, student loans, they're in a very interesting spot. They're coming off a payment moratorium that began during COVID and just ended in October of last year, where payments were required to kind of restart again. Now, you're seeing a vertical rise in delinquencies here, and this is as a result of not making those payments and all of a sudden, turning them back on. We do expect further stress here in the consumer space, and there may be some contagion from student loans to other areas, as turning these payments back on is just adding another liability to households. The point on this slide is pretty interesting. Is that there may not be a one-to-one correlation between broader market index data and ABS. And here, the black line is the student loan delinquencies that we saw from the previous chart, but we're overlaying it with a blue line, which is student loans that are found in asset-backed securitizations. So payments never turned off on the subset of loans that are in asset-backed securitizations, and overall delinquencies are much lower than what is held on government balance sheets. So it's fair to say that these pools of assets have been performing better and just are overall better quality. When you layer on other protections that ABS affords investors, it can start looking like a very interesting investment. So perhaps the takeaway or the lesson here is that headlines may make sectors sound very challenged, but there still may be an attractive secured investment via asset-backed securitization. Okay, we talked about the lending, tighter lending standards a couple of slides ago. This chart shows it in action. What we're looking at here is net loss experience of personal loans over time, and it's segmented by the year the loans were issued into the consumers. Now, as we just said, 2022 very loose lending standards. Well, 2022, when you look at it today, was somewhat of a disaster, and this is the gold line that's at the top of the screen. With looser lending standards, the stimulus program was also ending during that period of time. It does result in a steeper loss curve, and it indicates that borrowers were defaulting at a greater magnitude and then also at a faster pace. When this data started rolling out, and we get it almost real time, we get it on a monthly basis, we spoke to a number of the operators that we transact with in this space, and they assured us that they were adjusting their lending models. And so far, the results really speak for themselves. So if we look at 2024, which is the green line at the bottom of the page here, basically it's on top of the 2020 experience in terms of losses. It's on pace to be amongst the best performing years for personal loans that we've seen. We do see this as another risk mitigant. The fact that lenders adjusted their lending practices so quickly as the economy was slowing down. So we talked a bit about it. You certainly can get access to the consumer on a secured basis with ABS investments, but the commercial side also offers elements that make it very attractive. And here we're looking at shipping volume between various locales. And with tariff implementation, shipping volumes have seen a sea change between certain routes. Asia and North America typically has been the busiest route, but it's seen almost a 15% drop year over year in terms of volume. This has been offset, though, by a 16% increase in volume between Asia and Europe. So if you look at global shipping volumes, they're actually not meaningfully changed because of this. Now, ABS securitizations can involve shipping assets, and they generate these types of revenues regardless of what route they're on. So it doesn't matter that North America slowed down between Asia. If Europe picks up and those assets are being utilized there, you're generating revenue for those assets. A little bit more detail on the shipping side. Here we see shipping rates, and they have been wildly volatile. And it didn't matter if it was Asia, North America, or Asia, Europe route, it was just wildly volatile. Now, we do expect this to continue, and geopolitical risks and also continued tariff discussions is going to be a driver. But as an ABS investor, the assets that you own, they can be under take or pay contracts. And what that means is, regardless of rates, or even if assets are even being utilized, the operators must make payments on these assets. So the ending result is you have an investment with a very predictable, stable cash flow stream, and that can be very valuable, especially in a slowing economy. Another interesting chart, and very colorful at that, what this chart shows is various airlines around the world and the number of aircraft in the airline's fleet that are not owned, but instead leased. So I bet a lot of you didn't know you're likely on a rental aircraft last time you flew somewhere. And if you look, American Airlines leases almost 50% of its fleet, Southwest only about 10%, and then British Airways, which is IAG here in yellow, leases more than 70% of its aircraft fleet. These leased aircraft, they can be pledged into asset-backed securities, and then investors are entitled to all the cash flows associated with these assets. And these assets have contracts, and they can be very sticky, meaning it's very difficult to break these, and it results in consistent cash flows. It's not just the cash flows, though, that have value to these types of investments. As an investor, we're also secured by the asset themselves. And staying with the aircraft example, here we're looking at a chart. It's showing off-lease aircraft over time. COVID was a challenge. I mean, I would actually probably call it a debacle. Close to 20% of aircraft were off lease during that extreme event. I should add that has never happened in history before, but we did want to show it as an extreme event. Today, only or less than 4% of all aircraft are off lease. And how this benefits investors, it's that we do have first lien on the assets, and these assets generate cash flow. And today, because it's a very scarce asset. It also does have a tremendous amount of value. So you can liquidate those assets to essentially generate cash flow as well. So that is a very big positive for asset-backed securitizations. This is going to be the last industry I cover before I pass this over to Fifi to discuss portfolio positioning. We did say through the title of this webcast that investors can access the real economy in a secured manner through asset-backed securities. Well, everyone is talking about artificial intelligence these days. And on this chart, we're showing telecom construction's contribution to real GDP. And in the first quarter of 2025, that was more than 1%. That's really huge. AI, it requires the ability to process vast amounts of data, and this is done through digital infrastructure such as data centers, and these types of assets can be accessed through asset-backed securitizations. One point though, when you talk about data centers or AI, one of the concerns, or the biggest concern I would say, specifically around data centers, is overbuild of these assets. And that's a fair point to bring up. But looking at this chart, what this shows is new construction of data centers over time. This is yellow, in yellow. And the amount of pre-leased capacity that is being essentially absorbed before the completion of these projects. And that's in blue. In 2024, there was more than 6,000 megawatts of construction, but less than 2,000 megawatts are available for clients even before construction is complete on these assets. So despite all of this build out, which is really record build out in this space, it doesn't look like yet there's oversupply. As a matter of fact, quite the opposite at this point in time. With short supply and strong demand, what that translates into is just higher lease rates on these assets. And here we're looking at lease rates, and we can see that from 2021 through 2024, lease rates were really going one direction. They were rising very quickly. For investors, this has been a real positive. It's resulted in strong cash flows. These assets have been increasing in value, and this has translated into tighter spreads in this space. So it's really helping these investments on a total return across some of these sectors. It's a very exciting time in the market to be able to participate in these types of ideas. There's so many other sectors we can talk about, but we'll save that for next time. Right now, I'd like to pass it over to Fifi to discuss how we position the fund around some of these themes.
Thanks, Andrew. So now that we've gone over the macroeconomic backdrop, we'll turn to how the fund is actually positioned. And as I go over the next few slides, you'll see how the positioning aligns with some of the themes that Andrew just talked about regarding household resilience and hard asset investments that are contributing to GDP growth now. DABS is an actively managed ETF, so you should expect us to tactically navigate shifts in consumer behavior and asset trends across all sectors of the economy. So taking a look under the hood, all of the holdings remain investment grade, and that's consistent with our goal of providing a high quality credit portfolio. The fund also currently has 56% of the exposure to commercial ABS, and we're actually underweight versus the index in consumer ABS at 41%. For context, the BAML ABS index has about 70% of their exposure to consumer ABS sectors. DABS has a duration of 2.39 years. That sits at the shorter end of the curve versus traditional credit sectors like unsecured corporates, which has a duration closer to 6.5. We've intentionally positioned at the shorter end of the curve to capture any potential upside should rates rally from a Fed cut. It's also a way for the fund to stay defensive on duration while remaining opportunistic on spread. So on the next page, you'll see how the fund compares to the broader ABS market as represented by the BAML ABS index. At the end of June, DABS offered a yield to maturity of 5.8%, which is nearly 100 basis points higher than the ABS index yield. We're also invested the portfolio at close to a 2-point discount, while maintaining the current average target portfolio rating of single A minus. So with that portfolio construction, DABS has outperformed both the ABS index as well as the 1 to 5 year aggregate index since its inception at the end of February. In just that short period, the fund has experienced a pretty complex rate and credit environment. Andrew just highlighted some shifts in fundamentals such as rising consumer delinquencies and student loan defaults. But the performance of DABS has been strong despite these headwinds, and we think the fund can really deliver attractive returns even in a late cycle environment. Next, let's break down how we're allocating to the two components of ABS. Starting with the consumer ABS subsectors. Consumer ABS can actually be a pretty broad market, and we're diversified across the consumer collateral spectrum. Our largest consumer exposure is to personal loans at roughly 16%. We do think this area offers attractive loss adjusted returns, and the positions we have invested in for DABS actually benefit from very resilient and conservative deal structures. We also maintain a meaningful allocation to consumer debt tied to tangible assets, such as auto loans and home improvement equipment. These sectors are tied to essential spending for the household, which you just heard remains robust. With that said, we do want to be cautious going forward should there be a pullback in consumers, of course. We want to position the fund into more resilient parts of the capital stack. And the next slide more directly highlights that structural advantage of consumer ABS using personal loan securitization as the example. So, this chart shows the cumulative loss history of a personal loan issuer across all of their ABS deals in the bar charts on the bottom half of the page in gold. The leftmost point is the collateral loss of zero at the inception of the deal. And as you can see, when the deal seasons, and this particular issuer seasons, and we get to month 36, the issuer actually averages about 14% in cumulative collateral loss. Now, the blue lines above depict credit enhancement of each tranche at the inception of the transaction. Credit enhancement, to put it very simply, are your principal loss buffers and actually increase over time as deals amortize every month and delever. But we fixed the credit enhancement here to day one credit enhancement just to simplify the example. So, for example, the senior most tranche for these deals is double A rated, and the credit enhancement is 60% on day one, meaning that double A tranche would not take a dollar of principal loss unless the collateral loss shot up in excess of that 60%. And so for the single A tranche that we are targeting for DABS, losses for this particular personal loan ABS issuer would need to be in excess of 3 times higher than their actual historical loss experience to breach that credit enhancement level. This underscores how conservative the deal structuring can be for consumer ABS. And the sector currently provides pretty interesting spread opportunities while really mitigating that downside risk, again, should there be a pullback in the consumer. So, moving on from here, let's take a look at the commercial ABS exposure, which is about 56% of the fund. Our largest exposure are to aircraft assets or aviation assets at 22% and digital infrastructure securitizations at 21%. Aircraft leasing, as you just saw with Andrew, is supported by strong global travel recovery still. And digital infrastructure growth is still driven by this ever increasing demand for data usage, right? We're using data now for this webcast. Um, these trends are driving long term leasing activity and asset valuation and demands, which is really the main driver behind our exposure for commercial ABS. We invest in deals with long term cash flows tied to essential assets. These deals are also secured investments associated with some of the top tier corporate entities today, and they generally trade at wider spreads versus traditional corporate debt of these same entities. I'm going to walk you through an example of that. So, this example is using data center ABS. Data center ABS is a securitization of a portfolio of data center facilities that are leased to some of the most well known corporate companies today. One example of that that's highlighted on this page is a deal backed by leases to Microsoft. So, for context, the AAA rated Microsoft unsecured corporate debt trades at 15 over the 5 year treasury curve on a spread basis. The AAA rated tranche of a data center ABS that is 100% leased to Microsoft, priced at 130 over that same point of the curve. So in ABS, we are getting a much better spread for a very similar risk profile. Not to mention, the ABS is again backed by specific mission critical data centers that cannot be peeled away in bankruptcy proceedings. And they can also be released to other companies should the leases terminate for any reason at all. So this example really highlights why we like commercial ABS in that you get a spread pickup for high quality assets and long contracted cash flow streams. This slide shows the DABS portfolio. It's bifurcated by commercial ABS on the left and consumer ABS on the right. For each sector, we are comparing the credit enhancement in blue and gray. Again, credit enhancement are your loss buffers versus the average serious delinquency levels in red for those respective sectors for the positions that are held in the fund. As you can see, the loss buffers for DABs are quite a bit higher than the current delinquency levels. The fund isn't just prepared for any potential collateral stress, it's really built to withstand it. Now, moving on to the next slide. We just simply plotted the fund's actual subsector yields versus traditional corporate credit, which is in gray. The consumer ABS are in the blue color, and the commercial ABS subsectors yield versus our weighted average life are in gold. The fund, as you can see, is delivering pretty compelling yields with strong collateral packages again, which is especially valuable today in today's environment of rate uncertainty and pretty tight asset valuations across the board. On the next page, we are showing a high level attribution of unweighted gross returns for the fund in dark blue versus the ABS benchmark return in yellow. You'll notice that not only did the fund outperform the benchmark, but the individual components of commercial ABS and consumer ABS also outperformed the benchmark individually. This attribution highlights that there is consistent alpha generation, right, across both the consumer and commercial sleeves of a portfolio. So this is the last slide for me. DABS is an actively managed ETF, so you should expect us to continue to actively allocate across all the ABS subsectors. Currently, in this contractionary economic environment, we are indeed overweight commercial assets. Looking forward to the balance of the year, I think you can expect us to continue to position the fund in this manner. We're focused on power energy securitizations, data infrastructure ABS, transportation assets. We've really built a strong foundation with early performance this year, and we'll continue to lean into these high conviction sectors that have contracted cash flows and really resilient deal structures. We do think that these offer the most compelling risk adjusted credit opportunities right now in this market. So, again, that's it for me. I'll hand it back to Andrew for some Q&A.
Yeah, thanks, Fifi. Well, we had a number of questions come in. We'll try to answer a few of these with the time that we have left. First question comes in on whole business securities and if we would invest in these. Uh, Fifi did cover it on the slide, so perhaps this answers your question. We do have whole business securitizations in this portfolio. We would say that this is a asset-backed centric fund, so we will invest entirely within the ABS space. Whole business certainly fits that mold. About 11% of the overall portfolio is in whole business securitizations. And the question goes on to ask about what types of securities we invest in general. Now, the entire market is kind of within the realm of possibility for us, but we would underwrite each position on a transaction by transaction basis. So I can't essentially narrow it down to just certain types because we're going to look at every single transaction. I would say that there's kind of important metrics that we typically will care about. If it's heavily a dividend recap type transaction, it's not really going to be that interesting to us. We definitely prefer that the capital is being used for capex to improve the business and generate more cash flow. And then durability of cash flow is going to be very important, right? Investors in the asset-backed space, you have an asset to fall back on, but the other real kind of positive attribute to it is the ability to generate cash flow. So the durability of cash flow is going to be quite important. And then on the sector standpoint, again, it's going to differ. We'll look at everything from restaurant type securitizations all the way to other service providing industries within the whole business space. Let me see these other questions that have come in. Now the question asks about if we're all investment grade or if we use high yield opportunities in the portfolio. We do have the ability to invest up to 20% of the overall portfolio in high yield opportunities. Currently, there are 0% in high yield right now. And the reason there is because we are seeing pretty attractive spreads in the investment grade portion of the asset-backed securities market. And then if you look at the broader fixed income market, the credit curve is quite flat, meaning you're not getting really tremendous amount of compensation by going into riskier assets. And we do feel like there is a better entry point for those. So we absolutely will use the high yield allocation in this portfolio. Prefer to use it opportunistically. I would say against this current backdrop of a very flat credit curve, we really don't see that as a catalyst to be utilizing that segment of the portfolio. Another question around delinquencies, and this is really kind of uh, focused on the consumer side and asking, would we see defaults impact lower rated tranches? Now, it's certainly possible. Again, Fifi had a slide in there that would show how severe the losses would have to be on the consumer side in order to impact some of these tranches. We're invested in the senior, if not very close to the senior parts of the capital stack, and you would need to take, or you would need to see about 3x historical delinquencies in order to impact those types of tranches. And just to give you an idea of the lower probability of that occurring, even during the great financial crisis, losses were maybe 2x or less than what you've seen at like traditional historical levels have been. So to get to 3x, I mean, it would have to be something even more severe than great financial crisis. I mean, clearly anything can happen, but we do see the probability of that as being very, very remote. So I would say that the chances of loss are very slim in the areas that we're investing. And with the lower rated tranches, it's certainly possible. We're not really invested in that portion for the DABS portfolio currently. Another question just on losses in general, they ask historically, what have losses looked like in the ABS space? Um, you know, so I would just characterize it this way: the ABS market has existed for a very long time, all the way back into the 80s and 90s, and over that time, investment grade ABS has seen de minimis losses, almost zero, almost zero. Now, there have been a couple occasions where triple B type tranche took a loss, but that was very, very rare. So I would say almost zero in the investment grade portion. In the below investment grade portion, have been some defaults, but again, nothing severe compared to other areas of below investment grade type markets within the fixed income space. Another question that comes in asks about asset growth in the ETF. Is there a limit of opportunities? I would say absolutely not. And the reason I would say this is because, over the last 10 years, DoubleLine's been involved in asset-backed securitizations longer than 10 years. But over the last 10 years, the market has evolved tremendously. It has gone from predominantly a consumer-based market into a market where, all real assets are being secured in this space. So we talked about energy, we talked about AI and data infrastructure that's come up, and then transportation type assets. Those really did not exist that long ago, and those assets are being introduced in this market. And I just see other types of issuers, other industries seeing ABS as a viable financing option for them. So I don't think there's really a near-term limit here. I do think that the size of the opportunities is really could grow pretty substantially over the next several years. Another question that just came in is stating they're a retail investor. How would you use this fund as a retail investor? That's a great question. The way we look at AES is it is a credit fixed income play. So if you're invested in credit in fixed income as a retail investor, I do think ABS could be, or DABS specifically, could be considered as a complement or even a substitute for traditional credit. If you look at the performance of asset backs over time, in index data goes back 10 plus years, and you look at it versus traditional credit, ABS has done great. In many cases, it's done better, just because in many instances it doesn't have the rate volatility that traditional credit has had. I would say that as a retail investor looking to utilize DABS, use it in place of credit or as a complement to your existing credit exposure. Let's see. There are a lot of kind of questions that kind of overlap. Um, Yeah, the rest of the questions really asked about losses, delinquencies, and consumers, which I do feel we address. So I don't want to belabor those points. If there's interest, please reach out to DoubleLine. We're very interested in this space. We do think it's a very good opportunity for investors, and definitely appreciate the time that you guys took to listen to the webcast today.